Good afternoon, everyone. This is Mike and Corey today. Going to cover some different topics. I'm going to talk about 1 in 5 workers at age 55 not prepared yet for retirement. And I'm 55, so I'm right there as far as considering the timeline. Then I'm going to hit Levi's and, the popularity of denim and what the Levi stock, unfortunately, I'll say, earnings and predictions, what happened with that today. And then Corey's going to hit on a favorite, I'm sure people have heard of, Walgreens, and what's called a yield trap. He's going to hit on that. So, but before I get started, this is a financial education presentation. You must do your own due diligence on anything that you hear. More disclaimer information can be found at ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So let me share my screen. And so this article, I just saw this a few days ago. Only 1 in 5 workers nearing retirement is financially on track. It will come down to hard choices. Now there's a real catchy thing. It's going to come down to hard choices. Of course, 1 in 5 workers nearing retirement, and they talk about age 55. Corey, am I nearing retirement? I don't feel like I am. But anyways, but according to this, I'm right in this group. So the rule of thumb, if you are 55 and have another decade of work to go, is that you should have about 8 times your salary saved. So, as you're calculating that in your mind, how much do I have saved? If you do not, they said the average would be $447,000 saved. That's 8 times the average U.S. salary. And then I can see it says the report jibes with another study. So I know that nobody 55 or older wrote this article because we don't use that word jibes. At least I don't. But let me continue on here. So what does that mean to you? And if you're listening to this with Ankerstar Wealth, we want to help you prepare for retirement. That is our job. That is one of the roles for us, is building up that retirement. And here's another thing, making sure you know where you stand. If you're at $0 or $10,000 and you're thinking you're going to retire in 10 years, you're probably not going to have it fully funded unless you can count on Social Security. But we want to be honest and hit that. And whatever you do have saved so far, we want to maximize the return on that at your correct risk level. So another article very similar, and this one is from CNBC. It says why inflation is still upending retirement plans. And here's the thing, before inflation really peaked up in 2022, hopefully you were on the right way. Sometimes I think we use inflation as an excuse. It's an excuse not to retire, or it's an excuse that we didn't save up as much as we should. But here's the kind of the key points I found on this one. It says 43% of 65-year-olds have postponed their retirement due to inflation. So, I don't know if that's really true. That sounds like a very, very high percentage of people postponing because the cost of goods have went up. Keep in mind, Social Security is inflation adjusted as well. So I feel like part of this is a little bit of an excuse, but maybe this is more appropriate. Almost half of 55-year-olds surveyed plan to work part-time in retirement, and there's nothing wrong with that. I certainly will be honest that I have no intention of just camping out on the beach at age 65. In fact, I'd be more along the lines of working full-time or mostly full-time when I hit retirement age. So, it's just something as you think about it. And if you're 20 years old and you're listening to this, the best time to start investing and saving towards retirement is now, so that you definitely do not reach this situation. If you're 55 and you're hearing this and you're thinking, I don't have enough, the best time to start saving is now. It's always now. It's like planning for the future, not waiting or making excuses with things like inflation. They're always going to be out there. Presidential elections, markets up and down. There's going to be all those things, but planning ahead is the key. And that's what we want to work with you at Ankerstar Wealth. So what's happening in the markets today? Levi's comes out with earnings, and they said there's a denim craze. So Corey, check out this picture. Take a look at that picture. That picture's from 1987. Obviously, that guy, who's a good-looking dude at Ohio State, was in the denim craze. So I found that picture of myself, and I don't know if I would have invested in Levi's or denim back then, how it would have worked out for me. But right now, if you're invested in Levi's, it has not worked out well. So Levi Strauss down over 15%.
Hey, Mike,
Yep.
Mike, what about the jacket though? Do you still have either of those?
I don't know if I do. I'll have to look. It might
Well,
not
I
it might not
wonder if
fit me.
what held up better, the stock or the jacket?
I don't know, but and those are three of my roommates in the dorms at Ohio State. I mean, if you happen to see this, guys, I give you credit. Phil, Brad, and I think it was Eric. So Levi, they came out, they actually hit their earnings, but they project lower. Actually, they just reiterated the same forecast. The market sold off on this. The market was like, we don't like this. It dropped, it's down 16% right now. I kind of was wondering, I was like, let me look at Levi's, let me look at like a year chart. And really at a year chart, Levi's doesn't look that bad, even with the drop. I mean, it went up like the tech companies did. But when you look at a little bit broader, like let's go to a 5-year chart, you can see that, that's not the kind of company I would want to be in for 5 years. It's basically break even where it is, pays off a little bit of a dividend. So, Levi's is not in our model portfolio, but, I just figured some of you guys out there wear denim. And, the trend, obviously you're not wearing enough of it because they're not upping the sales. So I think it's kind of a dying breed. So with that, talking about dying breeds. No, I shouldn't say that. It sounds so bad. My wife and I went to CVS yesterday, and we were sitting there. I let her run in, and I was like, the parking lot was pretty much empty. She came out, and she's like, I could barely find anyone other than a pharmacist in there. And I was kind of like, yeah, I don't know that CVS or Walgreens is doing that well in the pharmacy business compared to Walmart and Kroger. Because when I go in those places, the pharmacy is booming. There's lots of people standing in line. But when I go into CVS, at least the one in my hometown, and Walgreens, there's not that many people. Walgreens came out with earnings, and I'm going to flip this over to Corey, and he's going to tell you how those went.
Thanks, Mike. Yeah, as far as the earnings go, the company did miss earnings and they decreased or lowered their expectations for earnings the remainder of this year, and also announced that they're going to be closing a significant number of stores, though they didn't specify. I think right now they have almost 9,000 stores. Many of those will be closed, or a significant amount, their words, is what will be closing. What I wanted to talk about, though, is something that we see time and time again over the years in the stock market, and it's something called a yield trap. Now, yield, I love yield. I mean, that's one of my favorite words. But trap, I don't know. That might mean there's something else going on here. So, Walgreens Boots Alliance is a textbook example of what we call a yield trap. So things are going well for the business, possibly stagnating. Let's look at a little longer chart here. So there was that peak in the 2010s, but going back to around the year 2000, there were many times where the stock was kind of trading flat or just slightly above that $50-ish a share level. Now, on a 5-year chart, we see that performance related to inflation, consumer weakness, other pharmacy options starting up, people ordering photos online, lots of competition has really put pressure on this business. And that stock price started to trend down. It was reflecting that increased competition, smaller moat, less of a strategic advantage in the market. Now, as that stock price trended down, the yield was that they were paying the same dividends, and that yield, that dividend rate you were getting on the shares became very attractive. You could see in 2023, it was actually nearing a 10% yield. And people were thinking, wow, I mean, where can I get this juicy yield? All that income. I love that income. Well, lo and behold, the market was predicting the inevitable. And the market does this time and time again. The market was telling us the competitive advantage was dissipating, and in time, that dividend would also get cut. Walgreens was saying, no, no, it won't. But the market, we have to listen to. So you see, their last regular dividend of 48 cents a share was paid in November of 2023, and they cut the dividend in half. The dividend was cut in half. The shares have been more than cut in half. A year ago, a year ago you were trading around $40 a share, and today it's 11. So you've lost your capital, you've lost that dividend income if you were hoping for that, and you got trapped. We've seen this again just this year. Look at Leggett and Platt. This was, I believe, a dividend aristocrat or a dividend king. It had increased their dividend for 50 years in a row. And the market started a few years ago forecasting that, wait a minute, demand for these industrial spring furniture products started to drop off. Inflation, they didn't have the same competitive advantage. Inflation was getting them. And the stock price started trending down way before the dividend. They were increasing the dividend while this was going on. And the dividend, of course, that dividend yield was like 7-8%. It looked really juicy, but the market was telling us something until finally, maybe if you were relying on this income, boom, you got cut to 5 cents a share there. And of course, their competitive advantage was predicted by the market to flounder, and that did come true. So these yield traps pop up. We've got to be mindful of those, and we can't always, just because something's got a high yield doesn't mean it's the place to be.
Well, thank you. Yeah, it's a good lesson. And that's certainly one reason why, even when you're looking for yield, you want to have a diversified portfolio. You don't want to put all your eggs in one basket with one company. Even when it's a dividend aristocrat, which means that, they've done well in the past, but, when you start talking over 10, 20, 30, 40 years, companies come and go. It's kind of unfortunate, but that's just the way it is. And don't get too attached to them. So, with that, thank you for that lesson, Corey, and we hope all of you have a great rest of the day. We'll talk to you later. Bye.